Inflation uncertainties could catalyze near-term volatility, but the market rally remains broadly intact given an anticipated soft landing and a robust earnings outlook. After 3 consecutive months of hotter than expected US inflation this year, the US Federal Reserve is facing a higher bar in timing its first rate cut. We now expect the Fed to begin rate cuts in Q3 2024 instead of June, and expect a total of 2 cuts this year instead of 3. Broadly, we believe that the Fed is still leaning towards easing monetary policy and that inflation will continue to ease gradually. The Fed's favored inflation measure, which is the core PCE, appears on track to hit the Fed's projection of 2.6% by the end of this year. Moreover, there are at least 3 more months of data before a possible rate cut decision in Q3. An inflection in the rate cycle ahead is likely to lead to lower US Treasury yields. However, considering that the risk of a US hard landing has significantly declined, the scope for price appreciation in long-dated Treasuries is likely to be more constrained than we had anticipated. Thus, we raised our 12-month forecasts for the 10-year and 30-year US Treasury yields to 3.75% and 4% respectively. Despite the risk of a pullback in Q2 and rising geopolitical tensions in the Middle East, we believe that the backdrop for equities remains broadly favorable given our latest base case expectations of a US soft landing and a robust corporate earnings outlook. Therefore, we are maintaining an overall risk-on stance in our tactical asset allocation. In equities, we continue to hold an overall overweight stance via an overweight position in Japan and neutral positions in the US, Europe, and Asia Japan, while keeping Hong Kong and China equity markets on a positive watch. In fixed income, we hold overweight positions in US Treasuries, developed market investment grade bonds, and emerging market high yield bonds. We also have an underweight position in emerging market investment grade bonds. We now favor a barbell strategy in terms of duration, with a preference for the 1 to 3 year segment and 8 to 15 year segment of the yield curve. We remain constructive on gold as a safe haven asset and effective portfolio diversifier. I'm Eli Lee, and this is Bank of Singapore Research.
For more information, please refer to this month's monthly investment guide.